Why do intelligent, high-earning people stay financially stuck? Not broke. Not irresponsible. Not reckless. Stuck. Why do people who read investing books, max out retirement accounts, follow market news, and listen to finance podcasts still look up 10 years later and wonder why their net worth hasn't meaningfully changed? It's not because they don't know enough. It's not because they don't earn enough. It's because there is a silent behavioral leak draining their financial future every single month, and they've trained themselves not to see it. By the end of this video, you're going to understand why one deceptively simple habit has quietly built more first-generation wealth than stock picking, crypto speculation, or side hustles ever could. And more importantly, you'll know how to implement it in a way that compounds for decades. Here's the uncomfortable truth. Most people do not have an income problem. They have a behavior problem. Wealth is not built in the stock market first. It's built in your daily financial behavior. The market only multiplies what your habits preserve. And if your financial behavior is unconscious, the market has nothing to multiply. I've spent over a decade studying wealth accumulation patterns, not just returns, but behavior. I've analyzed high earners with low net worth. I've studied modest earners who quietly build seven-figure portfolios. And the difference almost never starts with income. It starts with control. Not control in the restrictive sense. Control in the awareness sense. The single habit that separates long-term wealth builders from financial drifters is systematic expense tracking combined with conscious spending audits. And before your brain dismisses this as just budgeting, pause. Because this is not about deprivation. It's not about spreadsheets. It's not about feeling guilty over coffee. It's about eliminating financial blind spots. Let me ask you something uncomfortable. If I handed you your last 90 days of spending, categorized accurately, would anything surprise you? For most people, the answer is yes. Research consistently shows that households overspend by 15 to 20% relative to what they believe they're spending. Not intentionally. Not recklessly. Just unconsciously. If you earn $75,000 and spend $60,000 annually, a 15% misalignment is $9,000 disappearing each year without deliberate choice. That's not small. That's not rounding error. That's behavioral leakage. And here's where psychology becomes expensive. Humans do not feel cumulative loss well. A $500 charge triggers pain. $10 charges barely register. Yet mathematically, they are identical. This is called mental accounting bias. It's one of the cognitive distortions studied extensively in behavioral economics. We categorize small expenses as trivial. But wealth is built, or destroyed, in the trivial. You don't lose wealth in one dramatic event. You lose it in quiet automation. Subscriptions you forgot. Insurance premiums never reviewed. Convenience fees normalized. Lifestyle creep disguised as deserved. Financial researchers sometimes call these zombie expenses. They move quietly. They auto-renew. They hide inside digital frictionlessness. The average household loses thousands per year this way. But here's the real power. This isn't just about cutting waste. It's about redirecting capital. If you free up $400 per month, a number that is conservative for most middle-income earners, and invest it at a modest 8% annual return, here's what happens. In 10 years, roughly $73,000. In 20 years, roughly $237,000. In 30 years, nearly $600,000. From money you were already spending. And that assumes you never increase it. Wealth is rarely built through dramatic moves. It's built through behavioral optimization plus time. Now here's where the strategic distinction matters. Saving money does not build wealth. Redirecting money builds wealth. There is a difference. When you track and audit your expenses correctly, 3 strategic shifts occur. First, you introduce spending friction. Friction is not restriction. Friction is awareness. When money leaves your account automatically, it bypasses decision-making. When you review spending monthly, you interrupt autopilot. An interruption creates choice. Choice creates control. Second, use surface optimization opportunities invisible without data. Most people feel responsible. But feelings are unreliable financial instruments. Data exposes truth. You may think you order food occasionally. Data might reveal $350 per month. You may think subscriptions are minor. Data might reveal $120 monthly in unused services. Without tracking, you are guessing. With tracking, you are managing. Third, and this is the strategic multiplier, tracking creates investable surplus. And surplus is the seed of wealth. You cannot compound what you do not preserve. Many high earners make this mistake. They assume income growth alone creates wealth. But if spending expands at the same pace as income, net worth stagnates. You've seen it. The $200,000 earner living paycheck to paycheck. The $70,000 earner quietly building assets. The difference is not salary. It is system. A landmark long-term study of millionaires revealed something profoundly unglamorous. The overwhelming majority know exactly where their money goes. They review expenses. They question recurring charges. They measure alignment between spending and values. They are not cheap. They are deliberate. Wealth builders are intentional capital allocators. Now let's talk implementation, because awareness without structure dissolves quickly. This cannot become a spreadsheet obsession. Sustainability beats intensity. Here's the strategic framework. First, automate capture. Use aggregation tools. Connect accounts. Let software categorize transactions. The goal is not manual logging, it's monthly review. Second, create a monthly audit ritual. 30 minutes. Once per month. No emotion. No shame. Just observation. Ask, does this align with my priorities? Is this expense delivering proportional value? Is there a smarter alternative? You are not cutting joy. You are cutting drift. Third, identify low-resistance optimizations. Subscriptions unused. Services overpriced. Convenience habits exaggerated. You're looking for quick reallocations, not lifestyle punishment. Fourth, immediately redirect freed cash flow. This is where most people fail. They cancel a subscription. The money stays in checking. It disappears into miscellaneous spending. Instead, you automate an equal transfer into investments. Make the surplus invisible. Force it to compound. Fifth, quarterly strategic review. Look for creeping categories. Gradual increases. Behavioral slippage. Small leaks become large drains if ignored. Now let me show you the identity difference. A consumer spends based on impulse and environment. A wealth strategist spends based on allocation. One reacts. One directs. Tracking expenses is not about numbers. It's about identity. It transforms you from passive participant in your finances to active architect. But let me warn you about the traps. Perfectionism will sabotage you. You do not need forensic precision. You need pattern recognition. Shame will sabotage you. Data is neutral. It is feedback, not judgment. All or nothing changes will sabotage you. Optimize one or two high-impact areas first. And tracking without action is useless. Information must translate into reallocation. Let's zoom out. If you redirect $500 per month starting at age 30 and earn 8% annually, by age 60 you're approaching $750,000 to $900,000 depending on incremental increases. Not from genius investing. From disciplined redirection. This is not flashy. It does not trend on social media. But it works with mathematical consistency. Here's the deeper truth. Most people search for wealth acceleration strategies. They should be searching for wealth retention systems. Because wealth compounds only after leakage stops. So here's your challenge. Not tomorrow. Today. Open your last 60 days of transactions. Scan for friction points. Identify 3 expenses that triggered surprise. Take one action immediately. Cancel one. Renegotiate one. Redirect 1. One action is enough to begin shifting identity. Because a year from now, the difference between you and someone with similar income will not be intelligence. It will be whether you decided to become deliberate. You don't have a money problem. You have a behavior pattern. And the moment you control the pattern, you control the trajectory. Wealth is not dramatic. It is disciplined. Master this habit, and you give every future dollar a job. Ignore it, and no investment strategy will save you. The market rewards capital. But only disciplined behavior preserves capital long enough for the market to multiply it. The question is not whether this works. The question is whether you are ready to become the kind of person who does. Your financial future is not built in big decisions. It is built in repeated, invisible ones. Start acting like a strategist. Your net worth will follow.